What if I told you that the biggest financial move of this decade didn't happen on Wall Street, didn't make headlines on CNN, and didn't crash markets overnight, yet it may quietly reshape global money, currencies, and power for years to come? While most investors were distracted by stock rallies, rate cuts, and crypto headlines, China has been executing a slow, calculated financial maneuver worth nearly $10 trillion. No press conference, no announcement. Just silent accumulation, silent selling, and silent repositioning. And the consequences of this move, one T stay inside China, they will ripple through global markets, the US dollar, gold prices, bond yields, and ultimately your purchasing power. This is not a conspiracy. This is not speculation. This is happening in official data, hidden in plain sight. The question is not if global markets will feel it. The question is when. Before we go deeper, understand this. Videos like this don't show you what already happened. They show you what's unfolding right now. If you want clear, data-driven breakdowns of global power shifts, financial strategy, and economic moves that mainstream media only explains after it's too late, then subscribe to the channel, like this video, and turn on notifications. Because what you are about to see isn't just news, it is a warning signal most investors never notice until the damage is done. For decades, the global financial system has revolved around one central pillar, the US dollar. Trade, debt, oil, reserves, and international settlements have all flowed through a dollar-dominated system built after World War II. And for just as long, China played by those rules, holding massive amounts of US Treasury bonds, parking trillions of dollars in dollar-denominated assets, and recycling trade surpluses back into American debt. But that era is quietly changing. Over the last several years, China has been restructuring its financial defenses, not in one dramatic move, but through thousands of small, deliberate decisions. It has been steadily reducing exposure to U.S. debt, aggressively accumulating gold, diversifying reserves, and strengthening its balance sheet against currency risk, sanctions risk, and financial warfare. This is not about crashing the dollar tomorrow. This is about preparing for a world where the dollar is no longer the only anchor. And when the world, second largest economy, with more than $3 trillion in reserves, starts repositioning at this scale, markets don't stay neutral. They adjust, they reprice, and eventually they react. In this video, we're going to break down exactly what China did, why it matters, and how this quiet 10 trillion shift could shake global markets far more than any headline-driven crisis ever could. China's gold accumulation strategy is not loud, dramatic, or sudden, and that's exactly why it matters. While markets obsess over interest rates and stock indices, China has been quietly stacking one of the oldest and most trusted forms of money in human history. As of late 2025, China's official gold reserves crossed roughly 2,303 tons, equal to more than 74 million ounces, marking over 14 consecutive months of net gold purchases. Month after month, without interruption, China kept adding. No announcements, no warnings, just steady accumulation, the kind of behavior you only see when a long-term strategy is already locked in. At current prices, that gold alone is now valued at over $319 billion, making it one of the most important pillars of China's reserve system. And this isn't symbolic. Gold now represents a growing share of China's total foreign reserves, which still exceed $3 trillion. That matters, because gold is fundamentally different from the paper assets China has relied on for decades. It carries no counterparty risk. It can't be frozen, sanctioned, printed, or diluted. And in an era where financial power increasingly intersects with geopolitics, those properties are priceless. Historically, gold has always reasserted its relevance during periods of monetary stress. When currencies weaken, when debt explodes, when confidence erodes, gold doesn't rely on promises. It simply exists. That's why central banks turn to it when trust in the system starts to fray. And China is not alone. Across the globe, central banks are buying gold at the fastest pace in decades. In fact, for the first time in modern financial history, global central bank gold demand is approaching, and in some cases rivaling, demand for U.S. Treasuries as a reserve asset. That is not a coincidence, it is a signal. For China, gold is insurance. Insurance against dollar volatility. Insurance against sanctions risk. Insurance against a financial system it does not fully control. By increasing gold holdings while slowly reducing exposure to paper assets like U.S. government debt, China is quietly reshaping the composition of its reserves to survive multiple future scenarios. Inflation, currency fragmentation, or even financial confrontation. What makes this strategy so powerful is its patience. China is not trying to shock markets. It is not declaring the end of the dollar. It is simply preparing for a world where monetary stability is no longer guaranteed. And when the world's second largest economy chooses gold as a cornerstone of that preparation, markets eventually take notice. Because gold accumulation at this scale isn't about today, S price. It asks about tomorrow's system. China's foreign exchange reserves are the financial backbone of its global power. And right now, that backbone is stronger than it has been in nearly a decade. As of late 2025, China's total foreign exchange reserves have climbed to roughly 335 trillion, marking their highest level since 2015. This isn't a sudden spike driven by speculation or short-term market swings. It's the result of consistent monthly increases, carefully managed in an environment where the US dollar has softened and global capital flows are becoming more fragmented. In a world drowning in debt, liquidity like this isn't just strength, it's leverage. To understand why this matters, you have to understand what foreign exchange reserves actually are. FX reserves are assets held by a country's central bank in foreign currencies and stores of value. They typically include US dollars, euros, yen, gold, and foreign government bonds. These reserves allow a country to stabilize its currency, pay for imports, defend against financial crises, and project economic credibility on the global stage. In simple terms, reserves are a nation's financial war chest, and China's is one of the largest the world has ever seen. But size alone isn't the full story. Composition matters just as much. For years, China's reserves were heavily concentrated in US dollar-denominated assets, particularly Treasury bonds. That made sense in a stable, dollar-centric world. But today's environment is very different. Trade wars, sanctions, financial weaponization, and political fragmentation have turned reserve composition into a strategic decision rather than a passive one. And China has adapted accordingly. Over recent years, China has diversified its reserves away from excessive dollar dependence, increasing exposure to euros, yen, gold, and other non-dollar assets. This diversification has helped stabilize the overall value of its reserves during periods of dollar weakness, while also reducing vulnerability to U.S. policy shifts. A softer dollar in 2025 has amplified this effect, allowing China's reserve valuation to rise even without aggressive capital inflows. This is financial engineering at the sovereign level. What makes China's reserve position especially powerful is its optionality. With over $3.3 trillion at its disposal, China can defend the yuan, intervene in currency markets, absorb external shocks, support domestic liquidity, or deploy capital strategically abroad. Few nations have that flexibility. Even fewer combine it with industrial scale, trade dominance, and long-term planning. This is why markets watch China's reserves so closely. Rising reserves signal confidence, stability, and preparation. They suggest that China is not reacting to the global system. It is positioning itself within it. And when reserves climb alongside gold accumulation and dollar reduction, it becomes clear this isn't accidental. It's coordinated. China is not just holding wealth. It is restructuring how that wealth is protected, deployed, and insulated from a rapidly changing global financial order. China's reduction of U.S. Treasury holdings is the most misunderstood and most consequential part of this entire story. This is not a panic sale. It is not retaliation. It is not a short-term trade. It is a structural shift that has been unfolding quietly for more than a decade. In 2013, China was the single largest foreign holder of U.S. government debt, with Treasury holdings peaking above $1.3 trillion. So that position made China deeply embedded in the dollar-centric financial system. Today, that exposure has been cut nearly in half. By 2025, China's U.S. Treasury holdings have fallen to roughly $730 to $775 billion, marking a reduction of over $500 billion and the lowest level since the late 2000s. What matters is not just the number, but the pace and consistency of the decline. China didn't T-dump treasuries in one dramatic move that would have spooked markets and hurt its own balance sheet. Instead, it reduced holdings gradually, year after year, allowing markets to absorb the shift without disruption. This is how strategic reallocations are done at the sovereign level. Quietly, patiently, systematically. Every reduction was matched with reinvestment elsewhere, into gold, non-dollar assets, domestic development, and alternative reserve instruments. The reason behind this pivot is simple but profound. U.S. Treasuries are no longer a politically neutral asset. Over the last decade, financial sanctions, asset freezes, and monetary weaponization have transformed sovereign debt into a potential vulnerability. For a country like China, a strategic competitor rather than an ally, holding excessive amounts of U.S. government debt creates exposure to policy risk it does not control. Reducing that exposure isn't an attack on the dollar, it's risk management. This shift also fits neatly into a broader global pattern known as De-Dollarization. Across the world, central banks are reassessing how dependent they want to be on U.S. assets. Countries are diversifying reserves, increasing gold holdings, settling trade in local currencies, and seeking alternatives to dollar-dominated systems. China is simply the largest and most disciplined participant in this trend. When a nation with trillions in reserves moves first, others pay attention. The implications for global markets are significant. Lower foreign demand for U.S. Treasuries means the U.S. must increasingly rely on domestic buyers or higher yields to attract capital. That can influence interest rates, debt servicing costs, and long-term fiscal stability. At the same time, China's reduced exposure gives it greater financial autonomy and insulation from external pressure. This is not about abandoning the dollar overnight. It's about breaking dependence. And when the world's second largest economy decides that U.S. debt is no longer the cornerstone of its reserves, it signals something much bigger than portfolio adjustment. It signals a gradual rebalancing of financial power, one quiet sale at a time. China's actions do not exist in isolation. They are part of a much larger, much quieter shift taking place across the global financial system, a shift known as de-dollarization. Over the past several years, an increasing number of countries and central banks have begun diversifying away from heavy reliance on the US dollar and US Treasury securities. This does not mean the dollar is collapsing. It means the world is slowly hedging against a future where the dollar is no longer the uncontested center of global finance. And that distinction is critical. Central banks across Asia, the Middle East, and parts of Europe have been increasing allocations to gold, alternative currencies, and non-dollar assets at the fastest pace seen in decades. Gold, in particular, has reclaimed a central role in reserve management. Unlike fiat currencies, it carries no political alignment, no sanction risk, and no dependence on another nation's policy decisions. For the first time in modern history, gold's share of global reserves is approaching levels that rival, and in some cases surpass, traditional reserve assets like U.S. Treasuries. This is not nostalgia, it is strategic adaptation. China's role in this trend is disproportionately powerful. As the world's second largest economy and one of the largest holders of foreign reserves, China's decisions send signals that ripple through global markets. When China reduces U.S. Treasury exposure, increases gold holdings, and diversifies into non-dollar assets, it normalizes those choices for other nations. Smaller economies watch carefully. If a country with trillions in reserves is preparing for a less dollar-centric world, ignoring that signal becomes risky. The pressure this creates on the dollar system is subtle but persistent. The US dollar remains the world's primary reserve currency. But reserve status is not permanent. It depends on trust, stability, and demand. As more countries reduce marginal demand for dollar assets, the system becomes more sensitive to shifts in confidence. The dollar doesn't need to collapse to lose influence. It only needs alternatives to become viable. Over the long term, this transition carries real consequences. Lower foreign demand for U.S. Treasuries can translate into higher interest rates to attract buyers. That increases borrowing costs, not just for governments, but for corporations and consumers worldwide. Currency markets may become more volatile as trade increasingly settles in multiple currencies, rather than one dominant unit. Commodities like gold, silver, and even strategic resources gain importance as neutral stores of value in a fragmented system. This is how financial power shifts in the real world, not through sudden breaks, but through gradual rebalancing. China is not trying to overthrow the dollar. It is helping build a system where no single currency holds absolute control. And as that system takes shape, markets everywhere will have to adjust. Because when money's center of gravity begins to move, everything connected to it eventually moves too. When financial systems shift, markets don't react evenly. There are winners, there are losers, and there are assets that suddenly matter far more than they did before. As China and other nations quietly rebalance away from dollar-heavy reserves, the first and clearest beneficiaries have been gold and precious metals. Throughout 2025 and moving into 2026, gold prices have continued climbing as central banks and institutional investors seek assets that sit outside political influence. This surge isn't driven by fear alone. It is driven by demand at the highest levels of global finance. When sovereign institutions treat gold as strategic insurance rather than speculation, price floors rise and volatility compresses upward. Silver and other strategic metals also benefit from this environment. Unlike purely financial assets, they exist at the intersection of money, industry, and geopolitics. As currencies fragment and confidence becomes more selective, tangible assets regain monetary relevance. This is why gold isn't just reacting to inflation. It was reacting to a changing global order. On the other side of the equation sit U.S. Treasuries. As foreign demand softens, particularly from large holders like China, the U.S. bond market becomes more dependent on domestic buyers. That structural shift can place upward pressure on yields, especially during periods of heavy government borrowing. Higher yields increase the cost of servicing debt, ripple through mortgage rates, corporate financing, and equity valuations, and gradually reshape market behavior. The system still functions, but it becomes more sensitive, more leveraged, and more reactive to confidence shocks. Foreign exchange markets feel these changes almost immediately. As countries diversify reserves and settle more trade in non-dollar currencies, FX volatility increases. Currency pairs that once moved slowly begin to fluctuate more aggressively. The dollar remains dominant, but its movements carry more consequence. Smaller reserve shifts now have larger price impacts because marginal demand matters more than it used to. This environment rewards agility and punishes complacency. For the U.S. economy, the long-term implications center on liquidity and financing. The dollar's global role has historically allowed the U.S. to borrow cheaply and export inflation abroad. As that privilege slowly erodes at the margins, maintaining financial stability requires higher rates, stronger domestic demand, or fiscal restraint, none of which are painless. This does not signal collapse. It signals adjustment. Meanwhile, China is quietly shaping an alternative financial gravity within Asia. By promoting trade settlement in local currencies, expanding regional swap lines, and strengthening financial ties with neighboring economies, China is reducing reliance on Western financial channels. This doesn't replace the dollar globally, but it builds a parallel system where China holds influence. Over time, that influence compounds. In a world where financial power is no longer centralized, markets become more fragmented and more revealing. Assets that once felt obsolete regain relevance. Structures that once felt permanent become conditional. And those who understand where capital is flowing next gain an advantage long before headlines catch up. When you step back and look at the full picture, it becomes clear that what China has been doing is not reactive. It's preparatory. With more than $3.3 trillion in foreign exchange reserves, steadily rising gold holdings now exceeding 300 tons, and a deliberate reduction in exposure to U.S. government debt, China has been quietly reinforcing its financial sovereignty. This is what long-term positioning looks like at the scale of a superpower. Not dramatic announcements, not sudden shocks, just steady moves that reshape the foundation beneath global markets. The reduction in U.S. Treasury holdings alone tells a powerful story. A drop of more than $500 billion from peak levels isn't an accident or a coincidence. It's a strategic recalibration. China is not abandoning the dollar, but it is clearly refusing to remain dependent on it. That distinction matters, because dependence is vulnerability and diversification is protection. In a world where finance and geopolitics are increasingly intertwined, the composition of reserves has become a matter of national security. At the same time, gold and alternative assets are regaining geopolitical weight. Gold is no longer just a hedge against inflation. It is a hedge against uncertainty, fragmentation, and financial coercion. As more central banks follow this path, the global monetary system begins to resemble something more multipolar, more cautious, and less centralized than the one that defined the last half-century. Power doesn't disappear in this transition. It redistributes. What makes this moment so important is that most of these changes are still happening quietly. Markets haven't fully priced them in. Headlines haven't caught up. And by the time the shift becomes obvious, the advantages will already belong to those who were paying attention early. That is how financial history repeats itself. Not with explosions, but with rebalancing. Whether you are a trader watching currencies, an investor thinking long-term, or simply someone trying to understand where the global economy is headed, China's financial strategy offers a glimpse into the next decade of market behavior. It suggests a world where money flows more cautiously, assets are chosen more strategically, and stability is no longer assumed. It is engineered. And this is why these quiet moves matter more than any single crisis. They don't shock the system. They slowly change it. If you want to stay ahead of those changes, not after they happen, but while they're unfolding, then subscribe to the channel and turn on notifications. In the next video, we'll break down what this shift means for the US dollar, emerging markets, and your portfolio, and how to think clearly in a world where financial power is being rewritten in real time.